Today, we're going to unpack a really remarkable story of transformation, one that comes straight from the latest economic survey. It's all about how India's banking sector went from being a point of major stress to, well, a real pillar of strength. So let's jump right into the numbers.
We're going to start with just one number, 2.2%. Now that's the gross non-performing asset ratio for India's banks. And let me tell you, this isn't just a good number, it's a huge deal. We're talking about a multi-decadal low. That means the level of bad loans in the system is the lowest it has been in a whole generation.
You know, the economic survey itself doesn't pull any punches on this. It describes the sector's resilience as reaching historic highs. So this isn't just some small cyclical recovery. The report is pointing to a massive, fundamental turnaround, and that really sets the stage for everything else we're about to talk about.
Okay, so beyond that one big headline number, what does a historic high actually look like on the ground? Let's break down the hard data, the proof that really backs up this pretty bold claim.
First up, let's talk about the capital cushion. Banks are sitting on a capital to risk-weighted asset ratio of 17.2%. Now, what does that mean? Well, think of it as a really substantial financial buffer. It means our banks are seriously well-equipped to absorb unexpected shocks without getting knocked over, and that is an absolutely crucial feature in the volatile world we live in today.
But the story gets even better. It's not just about preventing new bad loans. Banks have gotten so much better at cleaning up the old ones. The recovery rate on these non-performing assets has pretty much doubled in recent years. So they're not just healthier, they're way more efficient.
And you know, this isn't a story of just one thing getting better. The health is really broad-based. Profits, they're growing at a healthy clip, almost 17%. The slippage ratio, which is just a fancy way of saying the rate of new loans going bad, has settled at a really low 123%. And we're seeing this strength all across the economy, in both industry and services. So this all leads to the big question, right? How did this happen? Well, this incredible turnaround isn't just about a cleanup operation. It's actually the result of a fundamental rewiring of how the entire Indian economy is financed. The key concept to wrap your head around here is something called financial deepening. It sounds a bit academic, I know, but it just means the financial system is maturing. It's growing up, moving beyond just banks to a much more diverse and sophisticated ecosystem for funding, things like corporate bonds and other market instruments. It's a really important shift.
Let's just paint a quick before and after picture. The old model, kind of risky. You had large corporations that relied almost exclusively on banks. This concentrated a huge amount of risk right into the banking system. The new model is way smarter. Large companies now go directly to the markets to raise money. This takes a ton of risk off the bank's balance sheets and, crucially, frees them up for other priorities.
Now you might be thinking, hold on, if banks are lending less to big industry, isn't the economy being starved of funds? And that's a fair question. But this is where that financial deepening really proves its worth. The total flow of money to the commercial sector has actually exploded by a massive 44.7%. The system as a whole is providing more capital, not less. So if banks aren't just focusing on the big corporations anymore, what are they doing? Well, they're pivoting. They are turning their attention to a crucial and for a long time underserved part of the economy, micro, small, and medium enterprises, MSMEs. Credit to this sector grew by a really robust 21.8%, funneling capital right where it can power growth from the ground up. Okay, so this newfound health has a massive implication for all of us in the wider economy. It means that when the central bank, the RBI, makes a policy move, it actually works. A healthy banking system is like a clean pipe. It lets that policy flow directly to the people and businesses who need it. Well, let's look at the cause and effect right here in action. The RBI cut its key policy rate and injected a huge amount of liquidity into the system. And because the banks are healthy and well capitalized, they were in a position to immediately pass those benefits on. And they did in the form of lower lending rates for new loans. And the proof is right here. The lending rate on fresh loans fell by 64 basis points. That is effective policy in action, real, tangible proof that the system is working the way it's supposed to, making credit cheaper and supporting the economy. All right, let's zoom out. Why does all of this financial talk actually matter? Well, because this resilience we've been talking about has been transformed from just being a nice thing to have into a core strategic asset for the entire country. This quote from the survey just nails the shift in thinking. It says that policy credibility, predictability, discipline,
These things are no longer just virtues. They're not just nice-to-haves. They have become actual strategic assets.
So here's the crucial takeaway from all of this. A strong banking sector isn't just a shield against global shocks anymore. It's not just a defensive wall. It has actually become a stable launchpad, giving India the confidence it needs to navigate all this global uncertainty while it pursues its own long-term growth ambitions.
And that really leaves us with one final, forward-looking question. With this newly fortified financial core, what possibilities are now unlocked? How is India now positioned to not only withstand the next global storm, but to actually go out and shape its own economic destiny?